Okay, so now let's do another problem where we're looking at the buy, manage, sell model. Again, we want value for all stakeholders, which is enterprise value. We'll get our estimate of enterprise value, compare that to Mr. Market's, et cetera, et cetera, et cetera. But the buy, manage, sell model is more realistic than the perpetuity model because most entities are not going to be around until the end of time. But if we're, for example, a private equity team with equity investors and lenders, we can buy the company, control it, its equity and its debt for a small number of years, resell it. That's a lot more realistic and a lot easier to predict. So let's go ahead and check out one of these types of problems. So now we've got company Zebra, a profitable, debt-free entity, and it's operating in steady state forever. That's a dubious assumption, but it's not going to worry us too much for reasons we're about to see. And we've got an economy in recession, and Zebra stock is suffering a classic throw out the baby with the bathwater situation, where even though it's operating in steady state, it has not been affected by the recession. Because it's a recession, the price of everybody's stock has gone down. So our team wants to take advantage of that. So we want to buy it, even though it's performing really well. We want to buy it when its price is low, hang on to it until after the recession, and then sell it for a higher price and get a wonderful profit. So the asking price today for all of the firm stock is 100 million. And remember, there is no debt outstanding right now. It's a debt-free entity. So this is all we have to worry about to take control of the firm. And it tells us to the PE that corresponds to whatever. Someone on the team has already done for us an optimal capital structure analysis, and they believe, and the team agrees, that the optimal debt to enterprise value or debt to capitalization value ratio for the firm would be 45%. So that means 45% of the capitalization comes from debt and 55% comes from equity. Okay, and if the team goes ahead with this, what's going to happen is that 45% or 45 million of this price is going to be obtained by the company getting a loan of $45 million and immediately turning those proceeds over to the prior owners. That 45 million would come from the debt folks on our team, and then 55 million is going to have to come from the equity folks, which will be paid directly to the prior owners. So they'd get all of the shares and they'd burn 45% of those shares to make the share count go down. Okay, and then the equity folks are going to operate the company once they bought it for 2 years, and they're thinking the recession will be well over and prices will be recovered by then. And at the end of those 2 years, they're going to resell all of the stock, and the shouldn't say load there, the loan will be terminated, i.e. the principal will be repaid. So that they think that, remember, after they do this with the recapitalization, they only paid 55 million, right? The other 45 came from a loan. So they think that all the shares can be sold for 66 million. So that would give them an 11 million profit for the equity holders in 2 years. So that's how they think that this is going to shake out. And what should we find? Let's find our estimate of the company's enterprise value, and then we'll get the NPV of this project for the whole team. And that's going to come by subtracting the total price required to take over control of this company from what we believe is our best estimate of its enterprise value, coming from the present value of all the cash flows we expect to get out of this project. Okay, so what else do we have? We have a bunch of given constants, and once again, I've done most of the heavy lifting for us here, computing RE and our WACC from beta leverage using CAPM for RE, all that jazz. And so our financing structure is 45% of the capitalization, once the team is controlling the firm, wants to be coming from debt, and the rest wants to be coming from equity. So that means that the loan the firm has to take out is equal to 45% of the total amount needed to take over the firm, and the equity folks in the team are going to have to come up with the rest of the takeover control price of 55 million. And then I've got our key rates computed for us. Income tax rate doesn't change as a function of your capitalization. The IRS does not care about that. So we're taking the firm from no debt to some debt. So the interest rate on debt should be expected to increase. Again, the 7% represents the expected amount of interest the company would have to pay in its existing state if it took out a very small loan. So it would go from zero debt to a very small amount of debt. Over here, it's got 45% of its capitalization from debt. So the interest rate is, of course, higher. Okay. Same thing with RE. When we go from an unlevered firm to a levered firm, the risk goes up for equity investors as well as debt investors. And I've computed here our weighted average cost of capital for us. And you can see what I've done here. I've used our formula for weighted average cost of capital, 1 times the tax rate times our weight of debt times our debt interest plus our weight of equity times our equity cost of capital. So what we're going to need to estimate the enterprise value in this case is 2 things. We need to know the free cash flows we're going to get from year 1 of operating this company and year 2 of operating this company. And then we also need to know the free cash flow that we're going to get from selling the company at the end of year 2. So let's start with our operating free cash flow, which as always comes from our NOPAT minus delta working capital, et cetera, et cetera, et cetera. Okay, and we already have a partial income statement for this guy. And as was noted in the beginning of the problem, the company is operating in steady state. We don't know if it'll be forever, but we're only going to be involved for 2 years. So let's say it's a good assumption that the company will continue to operate in steady state for the next 2 years. So that means we don't have to compute 2 separate cash flows. Each of these cash flows available to equity holders and lenders is going to be the same for end of year 1 and end of year 2. So let's get to our NOPAT. We've got our EBIT here already, and to get NOPAT, we just need tax on EBIT. So let's say we've got our EBIT times our tax rate, which is up here at 35%. Okay, and that's 7. So now NOPAT is just equal to EBIT minus tax on EBIT, and that's 13. Again, with steady state, we're going to have no changes in working capital, and depreciation should be matching our CapEx. So our free cash flow to everybody should be equal to NOPAT. Okay, so now we're ready to value this entity, get our enterprise value, and get an NPV for the project. So the first thing I'd like to put down for us here is the amount that they're going to get on exit, which is going to be the amount they're going to get for selling 100% of the stock and then the loan principal repayment. So let's go up and grab their estimate of what they'll be able to sell all the stock for. And that is, here we go, 66 million. And we have to add to that the loan principal repayment. So the loan amount, the debt amount is going to be 45. So we add those 2 together, and total for the team, shareholders and debt holders, they anticipate getting 111 back at the end of 2 years. So now we're ready to get the team's estimate of the enterprise value, which is the present value of all the future cash flows they expect to get from the firm while they're involved with it. So I've got it worked out for us here. That's going to be 2 years of operating free cash flows, each discounted back by the appropriate number of years, and then that total resale price of stock plus debt discounted back again by 2 years, everything discounted back, of course, with weighted average cost of capital, or WACC. So we need our free cash flow times 1 over 1 plus our WACC, which is up here. They're changing the capital structure, so we expect that WACC to change. And there's for our first free cash flow, plus 1 over 1 plus E50 raised to the 2. Okay, and then finally, we need to include here our 111 and discount that back by 2 years. And that's 118.41, and that seems to make some sense. So that's a team's estimate of the enterprise value. Now we want to get the NPV for the project, so we have to consider now every stinking cash flow for this project, including any cash flows at t equals 0, which is, of course, the amount of money the team has to put out to get 100% of the shares and refinance the debt. And that's equal to our 100. And that's looking good. And let's maybe make that negative. And now we can get our NPV, which is 18.4 and change, and that's greater than 0. So this implies the model says go for it. As usual, in the real world, we want to do more than just our numerical modeling, but in terms of our model, enterprise value is 118.4, and our NPV for this project for the whole team is greater than 0, so let's go for it. Okay, that's it.